How are you, folks? Enzo DiCostanzo. Today we're going to be hitting the second part of that regression problem, so let's get right to it. Okay, so we dealt with last time here's the data, right? The closing data that we looked at for the S&P 500, the current month-over-month change, which is right there, and then the one that's designated as T minus, T minus, T minus that change. Looking at this from March, I could see. I'm looking at sort of how I did it versus what we did here. I picked the since T was the second. I played games with the time indexes, but that's okay. So, but yeah, so we have this. We have the data here. We have the percentage. So we've distilled it down to the data that we're looking at. So what we're trying to do is we're trying to predict or pick today's returns versus yesterday's returns. From yesterday's return. How the S&P is going to return today relative to yesterday. How it performed yesterday, and we're going to go through all of this, the residual and the formula and the slopes, and we'll do all those things. And again, coming from and actually looking at this, I see what says T minus one returns up here and Y or T returns. No, this is fine. Yeah, this is X. Yeah, this is X. Yeah. Right there. We're going to get to all that. We spoke about variance yesterday. We spoke about the Standard & Poor's index. And actually, it said it's a market capitalization index. So you might be sitting there saying, "Hey, professor, what's market capitalization?" So at the beginning of the finance book, it has this definition in there, and I obviously expanded it dramatically. It's the total dollar market value of a company's outstanding shares, not the debt. The shares. This is not the enterprise value. This is the value of this. That's the confusing thing that's out in the world about the stock market. The stock market is not a company valuation. It's an equity valuation, not a company, not an enterprise valuation. You got to. It's very that's a subtle point, but it's an important point. This is the market cap, and it's calculated by multiplying the total number of company shares outstanding by the current market price of the shares. That has nothing to do with debt. Nothing. Okay, so if a company has 10 million shares selling for $100 each, the market capitalization of the shares is $1 billion. Okay. The investment community uses this figure to determine the company's size as opposed to a sales or asset figures. And an acquisition of market cap is used to determine whether a takeover candidate represents a good value to the or not to the acquirer. But again, you got to value the debt. You got to value. Just think about that accounting. That accounting equation is so simple, but our math is so simple, but it's so beautiful in a sense where that really does tell you what to do. And I'm always disheartened when I hear a story. I forget what I was watching somewhere. Oh, it was something about pilots or flying or the airlines or something. And I forget what the documentary was, but one of the persons that in the documentary was a pilot who used to be an accountant, and he gets up there and goes, I hate accounting. And I hear that story so many times. It's what you do with it too. I do a specific thing that's very lucrative with it, so to me it's a big deal. But if you don't get to do private equity, if you don't get to do something where you're earning a lot from understanding the accounting equation, then I could see how just maybe not liking math. But again, I come from the culture. I come from the math culture where we like math, and it's the math room in a sense, even though it's engineering or whatever, physics or something. But that's the mathematical room, and that's just a part of it. So, but if you're doing accounting and you want to do something else or whatever, I could see how that could get confusing. But folks, at the end of the day, know yourself. And as one of my students just said, be indispensable, right? I'm trying to make you indispensable. So anyhow, so that's how you value the equity, the little mathematics, which is right here. The market capitalization refers to how much a company is worth as determined by the stock market. It's defined as the total market value of all shares of all outstanding shares To calculate a company's market cap, multiply the number of outstanding shares by the current market value of one share. Companies are typically divided according to market capitalization. And you have this large cap, mid cap. And again, a lot of this stuff matters to the portfolio crowd, which I'm not really a portfolio. I could be, but I'm just not. I care. I look at the deal and the accounting, and I look at the specifics of what's going on. So a large cap is market capitalization 10 billion or more, and then you see these ranges. I don't have these memorized. Okay, some people may say, hey, we demand you memorize these, but I don't know. So anyhow, and again, what a company's worth is an important task, and so you're valuing the debt part and you're valuing the equity part. That's the sort of the confounding thing about it. And the stock market, it's not as plain and simple as that. It's a quick and easy way to estimate the company's value by extrapolating what the market thinks it's worth for publicly traded shares. Now, there might be some companies don't have a lot of debt, and then the majority of the valuation would be the equity valuation. But if there's the debt, there's a big debt piece to it. Okay, that's also something that you need to keep in. And you want to compare that. Okay, you want to be able to compare that to your market capitalization, and then what your debt number is from the balance sheet, because that's about all you have. You don't really have the access. You have the Bloomberg terminals, and the daily quotes for the debt market aren't on whatever, MSNBC or something, whatever it is, something like that. The nightly newscasts. And here's another example. It says it shows the company, so it shows the size of the company is important because the company is a base to determine the various characteristics which investors are interested in, including risk. It's easy to calculate a company with 20 million shares selling at $100 a share would have a market cap of $2 billion. A second company with a share price of 1,000, but only 10,000 shares outstanding on the other hand would have a market cap of 10 million. So here, let's look at these. So the per share value is in the market's 100, and the other per share value is 1,000. So it's 10 times more. But if you have a lot of shares, the market cap can be 2 billion. Okay. And then if you have fewer shares, right? You have 10,000 shares only times $1,000 per share. You're looking at a market cap of 10 million. Okay. So even though the share price might be more expensive, but there's also less, it's a smaller company, fewer shares. And so you got to balance all of these things happening. And we do the math here just to sort of show you guys. And these little red triangles, this is how many shares and dollars per share and the market cap and the units and those kinds of things. So just be careful about, you want to understand how many shares are out there. You want to understand the market price. You want to understand all the pieces that make this up. Now, this IPO stuff, this is, I'm sure I have seen it in bits. I've never watched the entire movie because I can't, but what do you call it? The Wolf of Wall Street or whatever it is. DiCaprio is talking about, IPOs, which is, and they were at the party and they were complaining that the bigger firms were taking their IPO, but IPO is very lucrative business. Just very quickly, initial public offerings work like this, where a company, take as an example, let's take a technology company in Northern California, somewhere in San Jose area or Santa Clara or something like that. And they want to expand from, 5 scientists from Stanford to, a 100-person company. They're going to need bigger facilities. They're going to need a marketing budget. They're going to have to hire, hourly workers and, office staff. And there's expansion, there's costs in expanding from a research effort to a little more of a going concern, a company with some market value, a company that's actually up and running and doing business and selling. They design some sort of graphic chip or something like that, which is very common out there. So they need, whatever, some amount of money to do it. They need 50 million. They need 100 million. Let's say they need $100 million to expand their operations. So what they'll do is they'll go to more. So instead of saying, hey, we've exhausted our family money, we've exhausted our relationships and our network, and we knew a guy in school at UCLA or whatever, Berkeley, and then he invested, he gave us a few million, and somebody else gave us a couple million, and this and that, and they pieced it together. And just from their own network. But now you got to get a little more corporate. You got to become a little more of a juggernaut in a sense. You have to become a serious business, and an up and running business where there's a payroll to make, and there's payables to pay off, and things, receivables to collect, and all these things that characterize a business. So you want to expand. So you're going to go to Morgan Stanley, and Morgan Stanley is going to invest that $100 million in you in that company. Now, let's say we'll just pick it just so it's easy, make it easy. $100 million invested in some technology startup in Northern California, and there's 100 million shares. So when you have 100 million shares, every share theoretically, Morgan Stanley is investing at a dollar a share, kind of a situation. At a dollar share in the situation. Okay, that's what Morgan Stanley's basically doing. So, but here's what Morgan Stanley says: hey, they're involved in graphic chips, and we have still an expanding internet, still an expanding technology sector. So, they had a bunch of people like me got together. So, we looked at similar companies and market share and the market this technology companies attempting to penetrate, and saying, hey, we think the valuation of these shares, dollar is very low. We think the public will buy these shares for $10 a share, $20 a share. It can be that much. It can be that much of a difference. So even though Morgan Stanley's offloading capital into that company at a dollar a share, but Morgan Stanley feels that the demand for the shares could be $10 a share, $20, and it with a ceiling of $30 a share. And there might be similar companies out there with $40 or $50 a share, something like that. So what Morgan Stanley just does is, okay, we'll dip into our bank account, and the bank account is constructed from wealthy, sophisticated investors who can participate in those types of investments that are in the tens of millions of dollars, and say, okay, we'll take 10 guys, that we know will take their capital, and they'll be we'll have 10 people who will be 10% investors, and Morgan Stanley's the middleman, and they're going to take a cut of what's going on, and they'll make that connection. But here's the wonderful thing, though. So you say, well, why would those investors take a big risk on a Northern California technology company? And we don't know. They make graphic chips, and the investor's a philosophy major in college, and he doesn't know what a microprocessor is, or care, or any of those kinds of things. And the folks at Morgan Stanley might not even really know or care. There might be one person on the team that really understands what that is, what the potential for the next generation graphics processor is. So but here's what can happen, though. So those 10 investors that invested $10 million each and have 10 million shares at a dollar a share, the value after these shares are public in this particular company could be $2 a share, $3 a share, $4 a share. So on paper, they could easily expand their investment, 2, 3, 5 times, 10 times within a year or two. Now there can be, volatility and movement in the market value of these shares as you have a growing company and everything isn't perfect, and maybe they didn't get an approval, one of their experiments didn't go as planned, and the results weren't as good, or there's magazines at the time, magazines, but now they're websites, but magazines that were magazines in Northern California, that as the new hardware would come out, the different real serious technologists out there would rate this graphic chip, and this company, that company, the company, and they would somehow measure the speed, maybe even through internal software or something like that, of how fast these new chips were working, and would rate which ones. And I remember when Intel got knocked out of the top spot by some of the companies about a decade ago, and what a stir it caused in the stock price and in these communities. It's a big badge of honor that we have the fastest graphics processor, we have the fastest communications software, whatever it might be, or hardware, whatever it is. We have the technological edge, but those technological edges are fleeting. Okay, the technological edge from 1960 and versus today didn't last 80 years or 60 years or whatever it might be. It just doesn't. So and especially now, it does move very quickly, and there's development, and there's motivation to do that. There's motivation, and that's one of the beautiful things about this country. So that's how these IPOs work, where you have an investment, and you're hoping that you have a multiple time multiplication, multiple time appreciation of the value of your investment, as opposed to just leaving your money in the S&P 500 and hoping you're going to get 7% this year. Okay, but again, it takes $10 million to do it, or $50 million to do it, and you have to be sophisticated and know how the process works, and it's a whole thing that happens here. But that's what an IPO is, and it's the computation. So okay, so there's my story time for that. But after saying all that, you can compare the IPOs of these different companies. This one has twice the shares, but half the share price, but the capitalizations are the same numbers. So the moral to the story of this is that you have the same market capitalization, but you have different components that sort of got you there. And then it says it here. It says a company goes public, starts trading, and the price is determined by supply and demand for the shares in the market. There's a high demand for the shares due to favorable factors. The price, as the price increases, if the company's future growth potential doesn't look good, the sellers of the stock could drive the price down. So the market cap then becomes real-time estimates of the company's value. The formula for the market capitalization is as follows. Okay, so there's the formula right there. Okay. And then you have some of these other versions of this. Yeah, I mean, this just kind of repeats what we just said here. But uh, there's simplicity and effectiveness in risk assessments. So, looking at the market cap can be a helpful metric in determining which stocks you're interested in and how to diversify your portfolio. That's like driving your car and you don't have a speedometer or you don't have a gas gauge kind of a thing. Okay, it's a critical piece of the puzzle in terms of understanding what the market cap is. And then you have obviously you have large cap, mid cap, and we give a little definitions here. Small cap. So IBM didn't start as a gargantuan, that's for sure. Okay, as a company bigger than a lot of countries, and General Electric and these and General Electric is a conglomerate or was a conglomerate. So, but that's what's going on with that. So yeah, and look at liquidity is important, growth opportunities are important, and volatility is important. So again, so a lot of the terminology that you're seeing here, volatility is how the price moves. Liquid is how many of those shares are actually available, and then the growth opportunities is fundamentally what is this company doing, and is it the value to the world and to society, how that's going to be assessed and how they're going to fit into that. So certainly companies go through sort of all the steps as you go along, and then there's some misconceptions about market capitalization. It says it's often used to describe a company, but it does not measure the entire equity of only through analysis of the fundamentals can we do that. So here it says, although it's often used to describe a company, the market cap does not measure the equity value of a company. Only through analysis of a company's fundamentals can we do that. So it is inadequate to value a company based on the market price on which its base does not necessarily reflect how much of a piece of the business is worth. Shares are often over or undervalued in the market, meaning the market price determines only how much market is willing to pay for the shares. Yeah. So what they really mean, and the way they said it does not measure the equity. It does. Okay. But it's the market value of the equity. That's really how this should have been stated. Again, I got these notes from that online, the depository of notes, but this values half of the accounting equation. So if L is 0, it's all of it, depending on how much debt you have on the balance sheet. Okay, that's really what's happening there. So although it measures the cost of buying all of the company's shares, the market cap does not determine the amount the company would cost to acquire in a merger. A better method for calculating the price of acquiring business outright is the enterprise. Yeah. So and we'll get to that. Actually, I don't have it here. Yeah, here we go. This is there's a definition here. This just sure says enterprise value. It says it's calculated by taking the company's market capitalization, adding the debt, and then subtracting cash. Yeah, I mean that's logical. Many investors use enterprise value as a rough estimate of the cost of acquiring a company and taking it uh, uh, private. Okay, that's really what that. And you have to be, especially with what we're dealing with banks and acquiring banks. Cash is depositor cash. It's not. It's. I mean, technically, it's listed as cash on the balance sheet, but you got to be very careful with that reading. Okay, and what, because deposits are for the bank, they're liabilities. Okay, and that's got to be balanced out by cash and instruments and things of that nature. So you got to be very careful with how you classify all those pieces. But the enterprise value is basically, and we could do we could do something on that at some point. Uh, Here it says a measure of the company's total value is a more comprehensive alternative to equity market capitalization. Is that, see, we always love the chemistry. It's a bag, but it's a bag of money. It's like the chemistry beakers and things of that nature. We love all that. Yeah, there it is. There's the formula. Okay, it's just a repeat of what we just said. So how we get EBITDA. Yeah, there's an example there. I like this. I like this one. So 1 second, folks. Sorry. 1 second. 1 second. But yeah, so that's what enterprise value is, and that's I remember when I worked for Wall Street Training, we always we taught that a lot. So market cap is a valuable tool for an investor who's watching stocks. Yeah, it extrapolates what the market thinks that the shares are publicly are worth for publicly traded companies. The community uses the figure to determine the company size, opposed to using sales or total asset figures. And an acquisition, the market cap is used to determine whether a takeover candidate represents a good value or not to the acquirer. And then there's other pieces to this here. The difference between market capitalization and enterprise. That's a good question. Is it better to have a large cap or small market capitalization? What is market capitalization? Okay. It's the company's equity. It's the value of the company's equity is what that is. Changes, misconceptions. Okay. So you guys had all that. Okay, let's get to the regression piece here and let's continue to move through this. Okay, so we have this here. Okay. So we're here. So what we'll do I sort of flipped them around for some reason. I don't know why, but 175, 269, 139, 175. Yeah, so you don't have that. You don't have that top one. We have the April number here, right? Yeah, so what you have here, you're going to go back by one. Yeah, we're just sort of dragging these across. Uh, yeah, since you don't have that, yeah, because T is, and this one, T is April, and T before. Yeah. Okay. We're going to paste formula. And the reason I sort of hesitated there for a second is I know at the bottom I got to fix this. Yeah, we got to fix the formatting here. We got to fix some dates. I have a lot of this to fix. Control D. Okay, we did that. And what we'll do here, we'll copy, paste Formatting, paste, formatting. See, we're bringing the formatting down because we have a couple more years. We have a few more years of this. Paste, formatting, okay, and then hit escape. Yes, you're up to December, the 1st of December. You're up to that. Some of these, you have to just quickly finish out your border. It's a little tedious, and I know that, but hey, welcome to computer science. I mean, that's computer science is like that. Okay. All right, so you have your data. So let's not get hung up on, this T and that T and when it started, when it ended. Because we're gonna go bananas here, worrying about that stuff. Okay. So we have now the data. It's not the index values. It's these percentage changes. That's your data. Okay. That's your data. Is that okay? So it's index changes. That's your data. Okay. And this is kind of what you want to predict. Is what you want. Actually, these are both data, so we'll cut this like that. Yeah, because you're trying to predict today from yesterday's is really what you're trying to do. So okay. I'm looking at that. Yeah, I know what they mean by this. I know what they mean by this, or what I meant by it. What this means is this is what the data gives us for Y. That's really what this means. And this is what our equation is. What this is. This is what our equation yields for Y is that. Okay. That's what that is. That's what our equation yields for Y. Okay. So now that you have so we can't do what we need first. Is count these things and all those kinds of things. But here, let's say equals count parenthesis. Click right there, shift control down. 753 pieces of data. So your BZ, then you got to go to CA. And here's what you can do, because it's a little unwieldy dealing with this. This is 10 to 762, right? And 62 CA. CA. Okay. So we put the range in. We put the range in here, right? See, it says column CA, and it goes all the way down to whatever this is, 762. So again, you want to know how much data you have, especially in this, because this is, you're starting to get into real amounts of, real sizes of data sets. You're trying to predict this Y based on yesterday's return. That's really what you're trying to do. And now once you have your range here, see where it says mean, you could just do, you could do equals sum. Here, you could do it like this. All your data, copy, equals sum divided by right there. Okay. So the average return yesterday is about 0.66%. So we can take the whole process, and we have the same data set here. We'll just copy that, not worry about, and and what anything is necessarily called or whatever. There, that's 0.66. Once you have the means, and actually, interestingly, yesterday's data and today's data are the same, right? Because again, because you're dealing with 1,000 pieces of data, they were the same here too. So it went up a bit over the last couple of years from 0.64 to when we had 708 pieces of data. Now it's 0.66. We have 753 pieces of data. The deviation formula is, Do I have that formula here for you guys? Yeah, I didn't put that formula in there, but okay, that's fine. So here, let's do deviations. Okay, let's do deviations. Again, based on this data. So the X deviation is here. That's going to run minus the average X, and we'll lock that. And then we have, the whole sort of story here. AV formula. And actually, what we need to do, and I just realized it, what we need to do here is set this up. Oh, wow. I almost did it exact. Right? And I just eyeballed that. That was just an eyeball. We have to set this up where we have the appropriate formatting and all that. So, yeah. So you can, whoops. Okay. Yeah, and these are just, this is just the shaded version of all this. All right, so we're here with this. This is copy. We'll do paste, formatting, paste, formatting, paste, formatting, paste, formatting. All right, this is Y, which is right there. Okay, we'll do the next one, which is Y. And we'll bring this. This is actually, it will work out the same, but let's be technical about it. All right, these are just the deviations. And now it's in decimals, not really percentages. So we're going to copy this. Both HV formula. Okay, so we're here with this. And here we go. So this is paste R. We're bringing the formatting with us. Paste R. And you have to, especially with stuff like this, even though this is sort of intermediate steps, paste R. Okay. So we have all those. Which is that. Okay. We have the deviations. And now we have to work out the product of this. So equals product. That range. And you can see the numbers are going to get, it takes two small numbers, multiply, get smaller number. So, okay. Copy this. Alt HV formula. Copy. Paste R. See, so it's you're learning. This is the real computer science stuff, folks. This is the real computer science stuff doing stuff like this. There we go. And then escape. Okay. All right. So you have all of those pieces sitting there. What's next? You have the deviations. And then you're going to square the deviations. That'll be next. And I guess you could do this in a couple different ways. I don't know if we have I forget if there's a squared function, but you could just do it the old school way. Like that. Okay, that's your deviations there. And that's your Y deviations. And now what we can do is we can just take a big hammer, in a sense, right? Say copy and just go across, go all the way down. Alt HV formula. Clear out clear out the shading. Okay, we brought the formatting in. What does it seem like we're off a bit here? We're off a bit. Yeah. Okay. Save. As you're going through these steps, you want to keep saving what you're doing as you go along. Okay. That's just a product. And again, this is, this was sort of taught as an extra in one of my classes. So I didn't really go through like the statistics books version of how to do all this, but it's basically this. You're basically, you could leave those gray blocks here. So it just reminds you that you're sort of not it reminds you that you're not using these two pieces here. Okay, so we have this. So we have all the pieces that we need to sort of construct this. or to construct the standard deviations. So you can do it for X, you can do it for Y, and we're lucky in the sense where we have the formula here. We have the Excel formula. We can sort of test what's going on here. For some reason, the deviation was divided by the mean. I don't know why we did that, but okay, we did that for some reason. So okay, so the deviation that we're computing is you're gonna compute the sum of the squares. You're gonna divide by 1 minus how many products you have, and then take the square root of that. That's the formula. And you can look up the standard deviation formula in any textbook, so in any statistics textbook. So equals sum. Was it the square deviations with this? That's Excel. Yeah, it was the squared ones. It was so yeah. So you did a column of that, and this is the great thing about Excel. So you're going to sum those and divide by, and then square root. Okay. So sum. Divided by parenthesis. N minus 1, close a parenthesis, and we're not done with this. And then you're going to go out right out between the equal sign and that S. You're going to say SQRT, parenthesis, and parenthesis. Okay, so you have about a 4% deviation, 4.3% deviation. Okay, that's what you have. Now, you're going to say, oh, well, professor, how do you know? How do you know? How do you know? That's just for Y. Okay, that's just for Y. So let's go back to our count, and we're going to pick up the range of data, the original, what I consider our Y is. You're going to say equals standard. And here, let's check. That's just standard deviation. So equals, and how's that spelled? STDEV. And surprise, surprise, you have the same number. So I took that range of data, right? That forgetting about what I squared, all those other things. We just took the data, and Excel did what we just did and came up with the same number. Okay, came up with the same thing. Yeah. So in other words, your returns today on average are about 0.66% on the day, and those varied by about 4.3%, plus or minus, up or down. That's what we're saying there. So that's a pretty good conclusion. Yeah, that's a pretty good conclusion to sort of to get to. Okay, that's a pretty good conclusion to get to. So, and that's just that little part of it. Okay, that's just that little part of it. And then you can do the same process up here. Okay, and now you're going to do that with the X's, which is still, and you should get a similar number. Did I get a similar number? Yeah, almost the same number, just off by moving it one data piece or whatever it is. So this was actually here. After all the thinking that we did, we can just say copy. We can drop it in there. What's that data? The data is this. Okay, so that we took. So the 753 minus 1 that came with us. All we have to do is change that data set. So instead of CH, it's CG 10 to 762. Same thing, right? Now you just use your square deviation. See, once you do the sort of the tough part of getting the data lined up and getting everything accurate from a time series point of view, now you're just going through steps. Okay. Same thing, 4.3%. And again, you have some sense in your head now. How much what's the deviation in the return for the S&P 500, the monthly return, right? So in a month, you're looking at about a 0.5% return. So think of your data, and with a deviation of 4, most 2 out of 3 data points will move by about 4.3% one way or another, or within that. Okay, so with the Excel, we just drop that in there. This data is not there. It's like that. All right. Yeah. That's your X. Yeah. 4.3 is your X returns in Excel, the Excel version. So the BZ10 to 762. Know your data range. All right. So now you've done here. Save this. You've done a lot of statistics now. Is what you've done here. You've done a lot of statistical work here. All right. Somehow the correlation is being computed, but let's not worry about that right now. And actually, I wanted us to do this. I deleted that. we want to compute that. We want to compute that. We should have grade that out. Yeah, let's worry about computing that. And we're still not done after all of this. We're still not even close to being done. What you need to do, and this is very simple or very basic in a sense, where you're going to create an equation that tells you as a function that y is see what says returns S&P 500 t. It should say as a function of t is really what this should say. This there. So your return today, based on yesterday's return, should conform to this equation with this slope and this y-intercept. And again, how well you are. And it sounds simple. Oh, the equation of a straight line. But I know from teaching the 102, I used to teach that, and I don't do it anymore. But I used to teach that 102. And if you have no sense of slopes and intercepts and those kinds of things, and you could see it's almost like people have flashbacks to their high school math classes where they struggled with it and said, "Oh my God, this again." Yeah, you could see that in the students' sort of reaction. Okay, so that's just something to keep in mind. And again, every time I do this, I like to think I get better at it. So you have a response variable, you have an explanatory variable. The response variable is what you're looking for. The explanatory variable is sort of the independent one that sort of moves around in there. You have predicted means your formula, and data means actually what happens empirically. So the residual is the difference between what happens empirically versus your formula. So and here it says S&P 500, the return or response is being predicted or explained by explanatory variable t minus. So yesterday's return is supposed to tell us what today's return is. That's what we think. Okay, that's what we think. There's other stuff here. You need the intercept equation. This is simply y bar minus x bar times the slope. And the slope is the correlation. Use the correlation coefficient. So here we have to get the correlation. Yes, I deleted this, but the correlation is basically, and again, there's a formula for this, and you can look this up in a statistics textbook. It's the product of the deviations, and you're adding those up, and then you're going to multiply by the standard deviation for y, standard deviation for x, and then divide by the count. Right, you're divided by the count is what you're doing, and yeah, that's on the denominator. So do we have the product worked out here? Yeah. So here, let's do that. So let's do sum of product. So equals sum. And here, what are these? This is 10 to 762, right? That's 10 to 762. So the beginnings of that, and then divided by something. But 1 minus this times the 2 deviations. Yeah. Now, minus 1 times deviation times that deviation. Yeah, it's about a similar number. 0101, 0172. Okay. Similar number. And remember with the correlation, remember it's plus or minus 1 and how so obviously if your correlation of 0, and this is almost 0, it's not going to be so already just from this statistic that we computed here, we're not going to have a very correlated line. So we're going to go through the steps of the equations of the linear model, but obviously from the get-go, it's not looking great. It's not looking great. So all right, the slope is the ratio of y to x deviations times the correlation. There we go. Yeah, because you have almost the same deviations. You have a similar slope, and this is going to be y minus x bar times the slope. Okay. Your intercept is not that different. 6365, not that different. Oh wow, did I find a mistake here? It looks like there's a little bit of a mistake. It looks like, yeah, because the intercept should be 0063 and yeah, oops, 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 oops. So looking back at this, yeah, these numbers aren't the numbers. 065. This thing. Right there. Yes, that even that needed a change. Okay, so this is going to be 50172. Yeah, that's it. Save. Now you have your predicted equation. So what you're gonna so this is the big sort of conclusion here. Yeah, that's your big conclusion there. And save that. And then you can take the so that's your predicted. So now what you can do is you can go see what it says predicted. You can hook in here and you can say equals and you're gonna program this equation in. Here's the intercept, which you're gonna lock plus slope, which you're gonna lock, and then you're gonna times this by what's x, which is yesterday's return. You can see the return, the actual return that happened, and what you predicted. These may not always be the same, and they're obviously. And for this equation is not really telling us much. We might get lucky somewhere, but it's not looking good, right? Here's the actual returns, and here's what the equation told us are going to be. Not great, right? So there's your first math experiment. All right, there's your first math experiment. So copy this. Alt HV formula. And we're going to be bringing the formatting with us. Formatting with us. Formatting with us. And one last time. Okay. So you can see hardly ever anywhere. So you might get lucky here and there where it might be a little bit close, but not too. All right. Those are a little close, but closer than this, right? 7% and 0.75, as far off as can be. It's pretty far. Okay. And this other thing here, this residual, and I apologize, I should have the formula at my fingertips here, but it's the data minus the predicted. So it's really the empirical minus the predicted. So equals the empirical minus, it's very far off. Yeah, that's almost a 2%. You're almost off by 2% here. Yeah, I don't know why those aren't formatted as percentages. I don't know why, but they should be. And again, as I'm going through my notes, I'm trying to see a better. Yeah, it's all these numbers again. Yeah, we're pretty good. Yeah, pretty good from doing it previously. I see the residual is way off, way off. So, and you'll see from the R squared, and you'll see from the graph of these, and we're going to make the graphs. Actually, looking at this and the time it took to do all this, so we could speak about this again. I think we spoke about capitalization today, so we'll do the S&P and the Nasdaq notes, and then we'll make the graphs in another video. So we're not rushing through all this. But even today, this was a lot. I think we did a lot today. So. What do we want these as percentages? So these are percentages. Again, with a little bit of patience. You can go through and format everything. See how we're doing? So we're just bringing over all the formatting. So these are good percent changed, different numbers. Okay. Guess we don't need any more. Okay. Save this. And then we have those three graphs to work on, which we'll do in another lecture. We'll also speak about the Nasdaq and the S&P next time. We'll look at the differences between those. And these go all the way across. And then save. And there you go. So you have your equation that we worked out. So this is the regression. So for the regression folks next semester, say, oh, well, where's the regression? Here it is. You can see this was a lot just for this one little thing. What this took to sort of explain this, and also some other pieces here. There's some of these equations that tell you. So 1 minus the correlation tells you the fraction of variance not accounted for, which is most of it. And you have to be able to interpret this stuff too. So this is equal 1 minus the square of the correlation. Yeah, so that's most of the variation is not accounted for with all the work we did. And then obviously what's left here equals this squared equals that guy. There it is. Okay. And I think you add these up, summed them. This correlation measures the strength of the linear association between the two quantitative variables. That's what that does. Okay. So you have, so now again, this was the trend line, and you'll see when we graph the data why we have what we have here. And folks, I'm embarrassed to say this. This is just sort of my solution sheet here. But why these look how they look? We divided the deviation by the mean. We divided. There's probably some reason why we did that. I can't recall. I have to look up what that represents. I apologize for not knowing that at the tips of my fingers, but okay, let's not worry about that right now. But there you go. Okay, so like I said, so and actually just to show you guys sort of the results of this and sort of where we're headed with all this, the graphs that we're going to be creating. There's 3 of them next time. There's the returns. These are annual returns since 1960. We'll work on the table for this. The table's down here someplace. Yeah, those are the year over year. I guess every December we looked at every December or something like that. We'll make that table. I'm not worried about that. We'll make that table. So this comes from, yeah. So we're going to need this. We're going to need the year of, and we'll do that. That'll be another lecture. And then this is the annual return since 1960. The current one versus last year or a previous period. You can see that it says the prices will follow. The conclusion is the prices will follow a random walk. So they're all over the place. So in other words, based on how you did yesterday, doesn't necessarily indicate your return today on an annual basis. And then this is the monthly relationship, right? The correlation is very low. Okay, the correlation. So that'll be next time. We'll work on that. Okay. Okay, folks. Thank you for listening. Oops, sorry about that. Folks, thank you for listening, and we'll see you soon.